In today's video, I'm going to walk you through the 3 most crucial mindset shifts that you need to make going into retirement. Hey everybody, I'm James Knoll, founder of Root Financial Partners, and I'm here to teach you what you need to know to create a secure retirement. It's no secret that life changes a lot when you retire. Now, most people view these changes through the financial lens of what changes to your portfolio, what changes where income comes from, what changes with tax strategy. Those are all very important. But there's also some crucial mindset shifts that must happen to accompany the financial changes if you want to have the most successful retirement possible. And in today's video, I'm going to walk you through what each of those are. The first mindset shift that you need to make as you approach retirement is you need to reframe the way that you view risk. If I just say the word risk in the context of investing, what's the first thing that comes to mind? Is it the 2008 stock market crash? Is it the 2020 market crash? Is it the stock market downturn we've had so far to start 2022? It's probably one of those things. It's some memory of the stock market losing value. That's how most of us view risk. Now, that is certainly one risk. To me, though, it is not the biggest risk. I like to view risk through the context of purchasing power. What's the number one thing that you need to be able to do in retirement with your portfolio? You need to maintain your purchasing power. You need to be able to buy groceries and pay for utilities and pay for travel today, but you also need to do it 5 years from today, 10 years from today, 20 years from today. And by the way, with inflation, it's going to cost a lot more in the future than it does today. So to me, the biggest risk is retirees not being able to maintain their purchasing power over the course of their retirement. Let's illustrate that. When most people think of risk-free, they think of cash. Cash seems very safe. Cash seems very stable. And in the short term it is, but let's look at an example. If you retire at age 62, let's assume that you and your spouse are both age 62, there's a high likelihood that one of you will live at least until age 92. Statistically speaking, one of you having a 30-year life expectancy is probable. Now, if you look at this, and if inflation rises 3% per year, which is about what it's done historically, then over a 30-year time period, $100,000 per year in today's dollars is going to be the equivalent of $240,000 per year 30 years from today. Meaning, if $100,000 is how much it costs to buy the bucket of goods and services that you rely upon to maintain your standard of living, that's going to cost $240,000 30 years from today to buy those same goods and services. So let's look at the real risk here. If we look at this, let's assume that you have $1 million and that all stays in cash. Well, in the short term, that feels very secure and safe because you're not experiencing any of the ups and downs of the stock market. But let's look what happens over the long term. If you have $1 million in cash and inflation increases by 3% per year, then at the end of 30 years, that $1 million would be worth about $416,000 in today's dollars. So if you had $1 million today and tomorrow it was worth $416,000, is that risky or is that risk-free? Now, the same exact thing is going to happen over time if you have too much money sitting in cash or too much money not growing. It just takes a lot longer for that to unfold. So as you're looking at this, you start to see how cash can be very risky or conservative investments can be very risky if too much of your portfolio is there. $1 million turns to $416,000 in terms of purchasing power over 30 years at 3% inflation. So you do need some money in cash. And by the way, I would love to hear from you. How much do you think is the right number of cash or right amount to have in cash in your portfolio or in the bank at all times? But I want to make sure you don't have too much. So drop a comment below to let me know what you think the right amount is. And in the meantime, let's look at an alternative. What if instead of keeping $1 million in cash, that turns to $416,000 when you equate it to purchasing power over 30 years? What if instead we took that $1 million and we invested it in the S&P 500, an index that tracks some of the biggest stocks in the United States? Well, over that same time period, historically stocks have averaged about 10%. So if we take $1 million and it grows by 10% for 30 years on average, that equates to $17.5 million 30 years from now. So put $1 million in cash today, you still have $1 million in cash in 30 years. Put $1 million in stocks, or put $1 million in the S&P 500 today, and you have $17.5 million 30 years from today if you get 10% per year. Now, even after inflation, if we back out what's the real purchasing power of that, that $1 million has turned to $7.3 million after inflation. So you start to get a sense for what's more risky between those two scenarios. The greater risk is not getting the growth that you need with your money over time. Now, I won't deny, when you own stocks, when you own aggressive investments, it comes with more short-term volatility. We're already seeing that this year. In fact, this year, in 2022, we've had the worst start to the stock market in decades. The S&P 500 finished the first half of this year down about 20%, which has been the worst start to the year in a very, very long time. So as investors, we do need money in cash, which is why I was interested to know what you think that right amount is, because we need some in cash to serve as a buffer, or we need some in conservative investments to serve as a buffer, because on average, once every 5 to 6 years, the S&P 500 will go down about 30% or so. Now, historically speaking, 100% of the time it has since recovered and gone on to hit new all-time highs, but that volatility is always going to exist. So in the short term, risk is those ups and downs of the stock market. But the reframing or the mindset shift that I encourage people to make is to understand the big picture of what's the greater risk over time. It's not these short-term but painful downturns, it's the long-term erosion of your purchasing power. The second mindset shift that people need to make as they approach retirement or transition into retirement is shifting from a focus of maximizing returns to maximizing resiliency. Now, I'm going to show you how this is the case through an analogy to tennis. If you like tennis, like this video. I love playing it, and I'm going to show you how tennis actually relates to your investments. Well, Dr. Simon Ramo, he wrote a book, and the book is called Extraordinary Tennis for the Ordinary Tennis Player. And in this book, what he did is he broke down tennis into two types of players. You have the professionals who are very skilled and know what they're doing, and you have the amateurs. These amateurs enjoy playing, but they're not so good at the game. Now, what he determined was this, is there's two very different games being played between the professionals versus those being played by the amateurs. Professional tennis players are playing to win. Professional tennis players are trying to place the ball perfectly so that it can't be returned by the opponent. Professional tennis players are relying on that incredible shot to win the game. Amateur tennis players, they're playing not to lose. You win by not losing if you're an amateur tennis player. You win by not hitting the ball into the net. You win by not faulting. You win by not being the one to make a mistake, and who can ever make fewer mistakes is the one who ultimately wins the game. Here's an excerpt from this book. It relates to tennis, but I'm going to show you how it also relates perfectly to us as investors. So this excerpt is from a book called Winning the Loser's Game by Charlie Ellis. In the book, he says this. It says, Dr. Simon Ramo identified the crucial difference between a winner's game and a loser's game in his excellent book on playing strategy called Extraordinary Tennis for Ordinary Tennis Players. Over a period of many years, he observed that tennis was not one game but two. One game of tennis is played by professionals and a very few gifted amateurs. The other is played by all the rest of us. Dr. Ramos summed it up this way. Professionals win points, amateurs lose points. Professional tennis players stroke the ball with strong, well-aimed shots through long and often exciting rallies until one player is able to drive the ball just beyond the reach of his opponent. Errors are seldom made by these splendid players. Expert tennis is what I call a winner's game because the ultimate outcome is determined by the actions of the winner. Victory is due to winning more points than the opponent wins, not, as we shall see in a moment, simply to getting a higher score than the opponent, but getting that higher score by winning points. Amateur tennis, Ramo found, is almost entirely different. Brilliant shots, long and exciting rallies, and seemingly miraculous recoveries are few and far between. On the other hand, the ball is fairly often hit into the net or out of bounds, and a double faults at service are not uncommon. The amateur duffer seldom beats his opponent, but he beats himself all the time. The victor in this game of tennis gets a higher score than the opponent, but he gets that higher score because his opponent is losing even more points. As a scientist and statistician, Dr. Ramo gathered that to test his hypothesis, and he did it in a very clever way. Instead of keeping conventional game scores, love, 15-all, 30-50, etc., Ramo simply counted the points won versus points lost. And here's what he found. In expert tennis, about 80% of the points are won. In amateur tennis, about 80% of the points are lost. In other words, professional tennis is a winner's game. The final outcome is determined by the activities of the winner, and amateur tennis is a loser's game. The final outcome is determined by the activities of the loser. The two games are, in their fundamental characteristic, not the same at all. They are the opposite. From this discovery of the two kinds of tennis, Dr. Ramo builds a complete strategy by which ordinary tennis players can win games, sets, and matches again and again by following the simple strategy of losing less and letting the opponent defeat himself. Dr. Ramo explains that if you choose to win at tennis, as opposed to having a good time, the strategy for winning is to avoid mistakes. The way to avoid mistakes is to be conservative and keep the ball in play, letting the other fellow have plenty of room in which to blunder his way to defeat, because he, being an amateur, and probably not having read Ramo's book, will play a losing game and not know it. He will make errors. He will make too many errors. Once in a while, he may hit a serve you cannot possibly handle, but much more frequently, he will double fault. Occasionally, he may volley balls past you at the net, but more often than not, they will sail far out of bounds. He will slam balls into the net from the front court and from the back court. His game will be a routine catalog of gaffes, goofs, and grief. So what does that have to do with us as investors? If you've played tennis before, you might be chuckling to yourself, and you might be understanding how perfectly accurate that describes amateur tennis. Well, as investors, it relates to us as well. Here's how. A lot of people come to me, and their portfolio is invested, and it's primarily invested in a group of large cap stocks, large cap growth stocks particularly. Well, from 2010 to 2011, this group of stocks as a whole averaged about 17.5% returns, an incredible streak of returns. So for these people, this is the winning that they've experienced. They've experienced a decade plus of winning returns. They haven't experienced losing in quite a bit. Let's take that though. Let's say, what if you were invested just in large cap growth stocks? And let's go back to the beginning of the century. Go back to the very beginning of 2000. If you took a full large cap growth portfolio, say you had $1 million, and you invested that $1 million into a large cap growth portfolio, let's assume that you're retired and you want to start pulling $50,000 per year from your portfolio. So you have $1 million, you want to pull $50,000 per year out, which represents a withdrawal rate of 5%. You would think that that would last for a very long time. If you're getting these returns of 17.5% like you had over the past decade, you would think that portfolio would last for a very long time. Here's the problem. You ran out of money in 2012. So had all of your money been invested that way, you would have had the $1 million, but you had $0 by the end of 2012, because not only were you pulling money out of your portfolio, but you went through some really tough years. And when the portfolio is declining, because we had a tech bubble that burst, we had 9/11, we had a recession at the turn of the century, we also had a significant downturn in 2008. When you're pulling money out of your portfolio and experiencing those market declines, you have a really poor experience. Now, compare that to the investor that's playing not to lose. The investor that's not trying to get everything all in one aspect of the stock market or all in one segment of the stock market, but someone who's maybe invested in a more diversified manner. Large companies, small companies, international, bonds, real estate, etc. That individual has been able to generate $50,000 per year, adjusted for inflation, and still has a very healthy portfolio. Now, the interesting thing is that portfolio as a whole hasn't performed better than just the growth portfolio as a whole if you take withdrawals out of it. But what it's done so well is it's provided resilience. It's provided different types of investments to pull from. So when just large cap stocks are down, or just small cap stocks are down, or just international stocks are down, you have other things that you can pull from. To use a tennis analogy, you're playing not to lose. You're not putting all of your eggs in one basket hoping to hit a home run. You're spreading out your money and you're focusing on resiliency as opposed to just maximizing returns. In retirement, you win by not losing. You win by having multiple options that you can draw from, and in doing so, it's giving you the resilience you need to get through even the toughest of times. The last mindset shift that people need to be able to make in retirement is switching from a savings mindset to a spending mindset. This is difficult because so often the people who are the most well prepared for retirement are the most well prepared because they have lived frugally. They've lived within their means. They haven't thought of themselves as being wealthy because they've saved so much of their money along the way. Well, they get to retirement, and when I look at their situations, they have more than enough to cover all of their needs. But just because they have enough, they don't necessarily feel that way. It's hard to flip that switch. They don't just go from being someone who saves and defers and is frugal to someone who can enjoy the fruits of what they've saved. Now, if you don't work on this, if you don't go from that savings mindset to that spending mindset, what you end up doing is you're going to have your money that just keeps growing and growing and growing. And sure, there are worse problems, but it's not a problem of your money just growing and growing and growing. It's a problem of what experiences are you missing out on? What would be special to you and meaningful to you that you're not doing because it's very difficult to go from that savings mindset to where you're saving everything to that spending mindset and giving yourself the permission to fully enjoy it. Retirement is not just a financial decision. There's the emotional component to it as well. There's a component of being free to spend, of being free to experience, of being free to do what you want to do, but to do so requires that mindset shift. It's great to have that savings mindset to get you to retirement, but working really intentionally to get to that spending mindset. Not to spend frivolously, but to spend on things that are meaningful and that would increase your quality of life. That is a crucial mindset shift that must happen for you to fully enjoy your retirement. So now that you know the 3 mindset shifts that you need to make to prepare for successful retirement, be sure to watch this video above so that you know if you're on track to retire. Thanks for watching. This is James Knoll with Root Financial Partners. If you enjoyed this video, please be sure to share it with someone else who you think would benefit from this information. And also, please be sure to like and subscribe for more content just like this. Finally, if you'd like to see how we help clients create a secure retirement, be sure to check out our website at rootfinancialpartners.com.